Good afternoon, everyone. Today is Friday, the 29th of June, 2012. This is Brian Shannon from alphatrends.net. We had a heck of a wild market ride this week as we had, well, news from the Supreme Court. We had rumors from Europe and news from Europe. And anyways, at the end of the week, we did finish positive for all the major indices. The S&P 500 was up 2%. The financials up 2%. And the financials survived further disclosure of losses from J.P. Morgan. So again, it was a really volatile week. Let's take a look at the 10-minute time frame. Each one of these candles represents 10 minutes worth of data, and we've got about 2 weeks worth of trading here. So we had seen a week and a half ago, 2 weeks ago, that as this market declined from the 136.10ish level down towards 131, that we started to retrace up towards that 50% retracement and a bit of prior resistance here as well, just from a week before. So, and then Thursday it looked like a pretty tough going for the market ahead, as we were below that declining 5-day moving average, and then at the end of the day, rumors got the market going, and then news today continued that momentum higher as it gapped up and briefly was flirting with this volume weighted average price, and as it broke higher, as it does a lot of times, it closed right near the high on these big gap days higher. So a lot of people look to fade this type of momentum and sell it short, but we were above the rising volume weighted average price for the almost the entire session, and now when we go back to the daily time frame, we can see that we're right back to that key level here at about 136 and a quarter, which was this prior support and then resistance about a week and a half ago. The good news is that we have now a higher low in here at this 131 level. It is pretty far away, being 5 points, but it is a higher low. We have a declining 50-day moving average, and we're right back also to this 100-day moving average. So it appears as though we're constricting in through here, and if the market can get above and hold above this 136 and a half-ish level for a couple days, then we could be back on new highs. It's just crazy, the volatility that this market experiences, and reminds us why we always have to keep an open mind. The trading software and analysis tool we're looking at is Realtick, by the way, and each Friday this video is put on YouTube because of the support of the people at Realtick. So if you're trading anywhere, use or check out Realtick and see how that platform would work for you. Anyways, this is also an important level, as we remember, or may not remember, but from the Fibonacci levels that we had seen from this little high back in April to the lows that we had seen in June, in May, I guess. Was that May or is that early June? I don't remember. Early June, I suppose. 2 weeks ago we came up and rallied almost pretty much precisely to this 61.8% retracement level. So for next week, this is going to be an important level, right up to about 136.65-ish. And I don't even know if I drew that correctly, but right up towards about 136.75, let's call it. Ideally, what would be a nice scenario to see would be a pullback, maybe Monday or into Tuesday, where this market kind of rechecks its balance here a little bit. Things settle down, and we get to determine which stock movements are real and which ones are just being caught up in this little bullish euphoria, maybe a little bit of end of quarter window dressing as the quarter ends on Monday. So still a lot of cross currents in this market, and nothing is very clear, except that there's a lot of uncertainty, and we still have to remain very vigilant towards risk management. So I think for next week, what we want to see is at least about the 134 and a half-ish area hold as some support. When we look at the 65-minute time frame, again, we see that these moving averages, the 5, 10, and 20, are flattening out and beginning to rise. So if we can do some further consolidation in this area, this 136.20 to 136.75. This is the band of resistance, and you could look at this now as we were looking at the inverted head and shoulders pattern. Well, that's kind of morphed now into what looks like a cup and handle. So again, technical analysis is not a science. There's a scientific analysis, I guess, of it, but there's an art of implementing it into the market, and no one has perfected that, I can guarantee you. So let's look for, hopefully, the market to kind of pause in here, maybe pull back slightly down towards 134 and a half, and then see if it can build the energy for a break back beyond this 136.75 ish level. The Nasdaq not quite up to the highs that we saw a week and a half ago, but clearly broke an important level of resistance here at this 63 to 63 and a half level. It kept right up to that, and here was this prior band of resistance that we've spoken about at 63 to 63 and a half. We got down to and recovered from that 62 level yesterday, so here we are. We've got a little bit of what's been resistance up near about the 64 and a half level. So, we'll see how the market handles this 64 and a half level next week. Again, I would say that ideally we want to see it rally up towards there, and then maybe a pull back down towards 63.50 to 64, and then build the energy for continued momentum higher. When we look at the longer term, we can see we've got that 100-day moving average right up here as well for the Nasdaq, similar to the way we saw it in the S&P 500, and we've got this 64 and a half with some prior support. So the market's rebuilding, and Russell, nicely back above that 78 level. We've spoken a lot about 78. This line has been on there. We got briefly above it. We were talking about, was this going to be from a failed move, came a fast move lower, and the market recovered. It held up above 75 all week. I was telling subscribers that, we're still in the middle of a range, that we're going to need to get back above 78 or so to really, and hold above it for this market to kind of be trusted to the long side again. And if we can get a pull back down towards 78 next week, that I think would be the ideal pullback scenario for the Russell 2000. That if we were to get that pullback and it holds in that level, then we can continue to do some rebuilding in here. We've got this little trend line that we're right upon in the Russell 2000, so it seems like a good place maybe to pull back from a little bit, and then our next upside objective, I guess, would be right around in here near about the 80 and a half level. This has been, actually we can draw that back even a little bit further. The 80 and a half to about 81 was a level where we spent a decent amount of time this year so far. So again, we're seeing impressive and surprising strength from this market. I think it took a lot of people off guard today. Yesterday's rally began late in the day, that last half hour, and I didn't think the prudent thing to do was to buy and to hold it into a rumor like that. So, and I think a lot of people were feeling left out today, feel like we're left on the sidelines. And you have to remember that outperformance in trading comes from not by buying and holding and participating in these gaps higher, but instead from outperforming on a consistent basis over time. And the days where the market is down 1% and you're up 1, 3, 5% or so, and you're not losing money the way the market does, that's where the real outperformance comes from, not from getting lucky on a gap. And I'm not suggesting that anyone who made money on the long side today was just lucky people who bought blindly into a gap and got that gap, but it comes down to a personal risk reward and what's comfortable for you. So the semiconductors survived a test of this 31 level this week. That's a big level we've been talking about, 30 and a half to 31. And, gap back up in here once again today, like the other markets did. And it came right back up to this prior level. So the band of prior support that we were talking about a week and a half ago as being potential resistance is once again showing that there are sellers who reside in that 29.95, or I'm sorry, 32.95 to 33 and a dime or so. So again, what we want to see is maybe a little bit further test of that 33 level, then some further pullback. And I'm looking at this daily chart and realizing that wasn't even a good print up there, that we had seen a bad print on the open. So we closed right near the highs in the semiconductors. But the point is still that 33 or so is going to be a challenging level for this market. Maybe we get a little bit of a rally up to there, then pull back and then get the upside. But holding above 33 and a dime or so for a couple days would be very constructive for this market. Like I said, J.P. Morgan, it was revealed that their losses had swelled to $9 billion on this trade, and it reminds me of pretty much a lot of other lies where people say, "Hey, we lost two. Wait a minute, no, it's five. No, it's 10." And where does it end? But the point is that news came out 2 days ago about that, and J.P. Morgan did not drag the financials lower. It's right, even above the volume weighted average price of the last 2 days. So J.P. Morgan didn't drag the financials lower. The financials closed right at the high end of the range today after gapping higher, and we're back above this important level. And it looks like maybe this time to hold above that 14 and a half level. So with a declining 50-day moving average, it's still going to hopefully do some backing and filling, and then be in a position where it can go on to challenge that $14.95 to $15 level as the next potential area of resistance. That's what we'll be looking for next week. And I hope everybody had a good week and has a good weekend. And thanks for tuning in.